Because we use numbers to describe markets, we can sometimes be fooled into thinking they're somehow mathematical or scientific or logical. They're not. Prices are a matter of opinions. They're the product of an organic, a human process, buyers and sellers expressing their views in the market and meeting to find the clearing price, the equilibrium price between those opinions from those buying and selling. And because of that, we sometimes find it hard to explain exactly what the market has done. And last night's trading is a great example of that. After a huge rally on Friday night in the US, last night saw the markets pull back. And in the exact reversal of the previous performance, the Dow was the worst performer and down the hardest amongst the three major indices in the US. The reasons are not clear, but it does seem very likely, given that the big rally on Friday night was a response to the idea of potentially easier interest rates, that last night's doubts that saw selling hit the markets also related to inflation and interest rates. And as we flagged yesterday, with a very important read on inflation in the US this Friday night, when we'll see the release of the PCE indicator, it does appear investors have got a little nervous after Friday night's confidence that the data coming out on Friday night might take some of the potential for a rate cut off the table. And if that's the case, we could see a selling reaction in share markets, and it's certainly what we saw overnight. So the S&P 500 and the Nasdaq both dipped slightly, down 0.2 to 0.4%. But that uncertainty over inflation and rate cuts, the doubts that emerged after Friday night's confidence, was the major driver of action. And we saw that across the board. There was evidence to support that. Bonds were steady and the US dollar slightly stronger. But Bitcoin dipped and is now trading closer to 110,000 US dollars, well down from that high we saw less than 2 weeks ago at 124,000 US dollars. And of course, that dip in Bitcoin is having a big impact on those shares that are directly exposed. Coinbase last night fell 4.3% in trading, and a lot of other stocks that have exposure came under pressure as the Bitcoin price fell. It's still results here in Australia that are driving the market, and that's what we saw yesterday. Both Reece and Event Cinemas were hit hard after reporting less than stellar results to investors. Both of those share prices down more than 10%. And yet, on the other hand, Ansell, which reported strongly at one stage, was up 16% in trading, still managed to close up 10% on the day after delivering a solid result, a good outlook, and a $200 million share buyback program. Santos has extended the time it's offering exclusive due diligence to ADNOC, the national buyer from Abu Dhabi. That means that there is still potential for a deal to go ahead, yet the market is expressing real doubts. With the Santos share price trading around $1 below the bid price, there's a clear expression of doubt about whether or not this all-cash takeover bid will be realised. But of particular note, and perhaps flying under the radar for some investors, has been the very strong recent performance of the Hong Kong market. Yesterday, the Hang Seng rose a further 1.9%, taking it close to a 4-year high. And that outperformance we're seeing in Hong Kong comes whether the markets are up or down, and quite likely relates to the potential undervaluation or the relative undervaluation of the Hong Kong market to other international markets. The reality is valuations are much less stressed and price to earnings multiples lower in Hong Kong, and that continuous outperformance that we've seen from the Hang Seng over the last 2 weeks could have further room to move as the Hong Kong plays catch up over the rest of 2025. We did see some fundamental drivers yesterday. Shanghai has eased property rules, and the ongoing issues with Evergrande were brought to an end with its delisting yesterday. And that was taken as a bit of a green light for investors in the market. It's still easy to argue that Hong Kong is undervalued. And we'll get further evidence to support that idea with major reports out this week. Meituan still to report, CITIC, as well as Trip.com, Li Auto, and Anta Sports, all coming out this week, all providing evidence or not for investors to consider whether or not there is persistent undervaluation in Hong Kong and whether or not it should be on their investment radar. Alibaba was up 5.5% yesterday in Hong Kong. Now, that's a very strong move given that it reports on Friday. There are a number of analysts with a strong buy on the stock. Once again, there's a valuation argument here. Alibaba shares valued in the US are trading at around 11 times earnings, and compared to the 34 times we're seeing for the NASDAQ index as a whole, that looks like undervaluation. They have streamlined their business. They've been exiting non-core businesses and focusing on their e-commerce and their cloud businesses, and investors appear to be rewarding that with the support we're seeing for the Alibaba share price. One to watch, and certainly a result to watch on Friday. Locally, though, Fortescue released results that showed a 41% drop in profit. Now, this was expected. Iron ore prices have come off from the previous year, so we were expecting to see things fall. But even so, at $3.4 billion, the profit here was below market forecasts. Stocks had a big rebound since June, and although they're predicting mine volume growth in WA, the reality is Fortescue hit record production in iron ore and yet saw revenues and profits down very hard. And what was very much brushed over in this result is the potential for green hydrogen and green metal. While the company promised it would continue to refine its green steel promises, the potential here is that there will be significant write-downs in the future, as it's acknowledged that the technology has simply not come far enough to make it practical in a business sense. So something to watch out for. There could still be a breakthrough. The engineers and researchers at Fortescue might still find a way, but at this stage, it does look like many of those highly environmentally sensitive initiatives are a bust. Looking at further reports today, we've got G8 Education. Now, it's reported higher earnings per share, but its share price has been in a big slide since June, and it has to do with staffing matters and a failure there to protect some of the students or the clients or the customers of G8. That big share price slide has seen it return to, in valuation terms, very low levels. The company did say alongside its result it expects difficult trading, largely implied due to the reputational issues that it's suffering from following its failures. But the underlying business here appears solid, and given the ongoing need for childcare, there's certainly a valuation argument to be looking at G8 from a share market point of view. Lots to still come through in terms of the Australian reporting season. The moves that we're seeing are showing just how influential it is. Go to the earnings calendar in your app or on the Moo platform to see when your companies are reporting and what their prospects might be.